Neeraj Shah, and to you and all of yours, happy festivities and have a safe time celebrating the Festival of Lights. Now, obviously, the next 30, 40 minutes, we'll be talking all about the key learnings that both our experts who are going to join us on the show today have of the Samvat gone by, and what is the key advice that they want to give for the Samvat coming up ahead. But remember, no such conversation can be had without trying to figure out what happened actually in the Samvat gone by. And it was not a question of performance really, because every fund performed. The question was which funds did the best, and across the key equity categories, which ones were top of the charts. My colleague Nikki has done all of this math, and she joins in right now with the key performers and the reasons as to why these funds would have done what they did. Nikki, happy Diwali in advance to you as well. Tell us, what do you have?
Happy Diwali to you and all the viewers out there. Samvat 2077, I'm sure we all know that it was a great year across the board when it comes to equities. You know, even the small cap and the mid cap stocks have pretty much participated into the rally after the difficult year that you've seen in 18-19. The funds have turned positive. But the star performers that we have across the board for all the categories, let's start off with large cap index first. The large cap category first, rather, where the benchmark returns have been to a range of around 45 odd %. But you have something in the likes of Nippon, Franklin India, and HDFC Top 100, which have done exceedingly well. They've delivered returns in the range of around 50 to 56 odd % as compared to the benchmark index return of around 45%. For Nippon India, what has worked well, it's typically it's got to do with the value bias approach, which has worked well in the favor. Franklin India is the valuation conscious approach and the overweight position that we have in the financial space, which has done well for this one. And of course, the star manager that we have, the fund manager Prashant Jain, which runs HDFC Top 100, that has also made it to the list. If we talk about a different category now as a whole, which is mid cap, you have, the category itself has done well. If you talk about the benchmark return, it's nearly around 67%, and the outperformers, they've delivered anywhere in the range of around 70 to 85%. PGIM India mid cap opportunity funds has done well. It's an 8-year-old fund, relatively has been doing well as compared to its counterparts. Mirai said here the fund manager has been managing a lot of schemes, and all of them seem to be doing pretty well for themselves. And we have Edelweiss Midcap Direct, where the strategy rather of investment in quality business, which profitable products have been, probably outperforming and working in the favor of this particular fund. Multi-cap category is the next category that we have in our list, where the mid-cap returns are in the range of around, the index returns are around 50 odd %, and the fund returns, they've delivered returns in the range of around 58% to 70 odd %, with the first one again being Nippon India, and second in the list we have Baroda Multicap and ICICI Pru again. For Baroda Multicap, it's the highest exposure to IRCTC, and ICICI Prudential, again, it's the exposure to financials, which is aiding the outperformance coming in on the fund. And the last category that we have on our list, of course, is small cap category, where Kotak, Tata, Nippon, again, I'm just repeating at the sense of cost of repeating Nippon India here again in this category. We've seen splendid returns coming in from this as well. 85 to 91% is where the outperformance is coming in from. The benchmark has delivered returns to an extent of 80%. So you can clearly see the asset class doing pretty well for itself. When we talk about Kotak, what has really worked well in the favor is the diversified approach. Tata Small Cap, it's actually the focused one. Radico, All Cargo Logistic, these are the stocks which have done exceedingly well, and the fund's performance, or the kind of weightage that it carried in the stock, has done well for itself and leading to an outperformance coming for the fund. And last in the category, we have Nippon India, where again it's got it sectorally right, and one of the outperforming sectors for the rally was chemical, and highest weightage in that particular category has worked well for this fund. With this, that's that, but I'm going to toss it back to you, Neeraj.
Okay, thanks, Nikki. Thanks. Kalpin Parekh and Ashish Somaya join me on this very special show. Ashish, can I start with you? The most important learning for you for the Samvat gone by, and why?
See, I think that, the last 1 year, in fact, I read it somewhere that, equities are for optimists. I think that was one of the biggest things which one realized, because 2020, usually, in fact, I wrote it somewhere, that generally speaking, when you talk to analysts or portfolio managers, they tell you that there is a bear case, there is a bull case, and there is the base case. But somewhere in 2020, it was only, world will come to an end case or world will not come to an end case. So, at one point in time, the market started believing that human beings are the next dinosaur. So I think if you really think that the world is going to come to an end, then I don't think, this is the right place for you. So I think equities are for optimists. I think that is what is the key learning, that if you stay invested and if you believe in human ingenuity, I think eventually you will come through.
Yeah, I remember a conversation that we had sometime in March 2020, Ashish, when you reflected upon this, and it turned out to be true. Well, okay, thanks for Ashish. So, interesting thought. Equities are for optimists. Kalpen, what about you? What was your key or the most important learning for the Samvat gone by?
I'll make a statement which we actually use very extensively in all our marketing campaigns. And we had come up with very large hoarding campaigns also. And my learning for the last year was markets fluctuate. And as investors, we should take advantage of them rather than get penalized by these fluctuations. So ups and downs are a part of the game. They are the rules of the game. And if we know them well, if we know what are the drivers and turning points, we can take appropriate advantage of these fluctuations.
Okay, fantastic thought then, Kalpen, well, markets fluctuate and we should take advantage of them. Frankly, think of it, viewers. Both our guests are saying the same thing. You would take advantage of market fluctuations per se if you are an optimist as well over the long term, because if the markets dip and if they dip quite strongly, then you might want to take advantage. And that is only possible if you're an optimist. Sure, if you run a long short fund, then it's a separate thing. For most retail investors and mutual fund investors, it's about investing for the future, and therefore be an optimist and take advantage of fluctuations. I think that's a very important thing. Frankly, if you use an SIP method, then the fund automatically takes advantage of the market fluctuations. So keep that in mind. Okay, the next point is aside of the key learning, even though our guests are veterans, I'm sure there are events or moments that surprise them as well. Kalpen, can I ask you that in the Samvat gone by, what was the thing that surprised you the most?
Neeraj, I think it was not very easy to remain optimistic in March and April last year, looking at how the health crisis was unfolding and mapping into an economic crisis. And what really positively surprised me was the massive resilience of good companies and corporate India, because ultimately that matters to us when we are putting our money to work. The way we saw over the course of the year, companies responded with smart realignment of business models, bringing down expenses, and doing whatever it takes to continue to grow and find solutions to do that, was something which was extremely very a positive surprise. Our own business, we had made a certain budget estimate in the June board meeting, and by the time we hit December, the numbers were very different and much higher than the estimate. So I think the world coming back, more importantly, companies responding to that very positively was a strong surprise. And the second thing, what was very encouraging was investors at large did not lose their cool. So we all were nervous. Unanimously, investors around the country were nervous about what's likely to happen, what will happen, personal cash flow issues, market volatility. Yet, I think a large part of investors kept faith in the asset class, continued to invest. Some of them who were smarter enough added more, taking advantage of these fluctuations. But net, we saw continuity in investment plans, continuity in SIPs. We saw more money coming in disciplined products like asset allocation. And I think to me, that was a very strong reinforcement that a lot of our investors are maturing and taking advantage of these fluctuations to fulfill their long-term goals.
Yeah, and coincidentally, there's a bit of a similarity here because Ashish, I believe you thought as well that the retail participants surprised you the most.
Yeah, actually, even I used to, in fact, frankly, quite ironic, but I observed that, people who have been in the market for 2-3 cycles and, maybe 2-3 decades even, I think for them, some of the past bad experiences of long drawn bear cycles I think, so, if you're really informed or colored by some of your past experiences, I think that worked out to a bit of to being a disadvantage. Whereas for a lot of the people for whom it was uncharted territory, I think they kind of, did it slightly better. So that was one of the key things. The second thing is that clearly, when you say, I think that, for everything we keep looking at, what was pre-COVID, what is post-COVID. And then, we start thinking that these are cycles and, in many aspects, we'll go back to pre-COVID, etc. But I think digital adaptation as it applies to capital markets, capital market adaptation in general, I think a lot of these things, I think they've changed forever. I don't think we are going to go back to a pre-COVID kind of scenario when it comes to these things. It was a long trend, got significantly accelerated, right? If we look around ourselves, our parents, even, my mom is 70, and I think she's got to ordering on, these food deliveries and the books and stuff, right? And we see youngsters, all of them, adapting to capital markets because of digital interfaces. I think some of these things have changed. It's now forever. It's a significant change. I don't think we are going back on this.
Yeah, and such a different world. 20 years ago, one could have never thought that something like this could exist. And who knows, if we have 24/7 stores coming in, then even that will change the face of cities and urban towns. So that could be interesting. But from a capital markets perspective, Ashish is so right. And viewers, it is as much a learning for us as it is for both the CEOs out here, because I'm sure they are looking at these trends from their business perspective as well. Okay. Moving on to the next question, and a piece of advice from both of you. Ashish, to you first. What is the biggest do and what is the biggest don't for the upcoming SAMVAT, according to you?
See, I think the easy returns are out of the way very clearly. Look, when you go, in hindsight, now we know that we got a vaccine in 6 months, as opposed to the thinking that vaccines take 5-10 years. And, we vaccinated 100 crore people. Thankfully, as of yet, no sign of a real third wave in India. I hope I haven't spoken too soon. But what I would say is that the easy money is out of the way. Very clearly, we are not in any undervalued kind of, screaming buy kind of scenario. Now it's more about being judicious and seeing where the growth is coming in, and, how companies and businesses are doing from here on. But that said, I think one has to stay invested, because recently somebody put out very interesting data that even if you think that economically and cyclically you are up for a good, for a good phase, still the best of market conditions have multiple corrections. Like, the point in time when we are talking about this, last few days has been, a sea of red as far as small and mid caps are concerned. So I think these are things which will happen even amidst a bull market. There'll be many temptations to bail out in the next year or so. But I would still say that people who stay invested, they are likely to fare much better than people who have this urge to react to every market development.
Okay. Kalpen, what about you? The biggest do and don't. And it's interesting that it's investing related that you're talking about, that people should probably diversify a lot. And the don't is very interesting because I think we keep on saying it, but I think people might still keep on doing it.
Yeah, so Neeraj, my big learning always and more so got reinforced in 2020 is that investing is not 2020. Investing is a test match. So it's very important to survive. It's very important to last long. And what really helps survival is diversification across asset classes which don't move together in the same direction every time. So diversification across asset classes is a very important learning that I would keep for life. And I will give you a live example. On 23rd March, when in last year, when stocks were tanking and were down 40% from their peak, knowing that you have 20, 30, 40% in fixed income gives you the comfort to say that, even if this correction were to last for longer, I don't have to dip into this asset pool because I have my fixed income pool or, my gold pool, which will live through the next 2 or 3 years. So even if there is a long drawn bear market, there is a fixed income component to take care of that. So to me, asset allocation and diversification is a very strong do. And from a don't perspective, again, I would say that, the more we get digital, the more we are used to constantly touching our gadgets and looking at our portfolio values. And, the quality of UI UX provokes us to sometimes press buttons very quickly, move money, switch money, redeem money and stuff like that. I think staying away, having done your investments, knowing that this is a long-term investment journey, stay away from watching asset classes every day. Stay away from watching prices every day. I myself do it very often and try to curb that instinct. I end up sleeping, looking at markets outside India and, wake up and after some time start looking at Nifty. But at times you realize, how does it matter? 20 years from now, it wouldn't matter that what was the price in 2021. So stay away from frequency of activity and just bring stillness to your portfolios. It will help a long way in earning superior risk-adjusted returns.
The diversify across asset classes, Kalpen, it has also got relevance from an international perspective as well. You look at international markets a lot. You believe people should do that as well increasingly?
Absolutely. My take on this is, there are enough companies in the world who are similar or better than Indian companies in terms of quality, in terms of scale, in terms of the profit pools that they cater to, in terms of the innovation. And finally, from an operating matrix, if you sort companies around the world on ROE, ROCE, earnings growth, valuations, there are easily 50 to 100 companies available outside as well. So what happens is many times in short cycles, India will do well and these global companies will not do well, or vice versa. So this low correlation, moderately low correlation also helps in better stability of NAV. So if you notice, last whole year, international stocks did relatively better than India and emerging markets. This year so far, I was just seeing since the time we launched a fund which had an international slice, since then, the international slice has underperformed India by 24%. So India has done well. But will I be able to predict every year which is going to do well or vice versa? No. So having a nice blend is very important. And I strongly believe that when you map profit pools, there are very large profit pools outside. Today, every conversation we do are on products, sold by global companies. So why not benefit from our own expenses? We are spending money on a lot of these global products. So how do we convert our expenses, which are their profits, back into our investment returns? So I think global diversification definitely makes sense at the right time, not because the last 10 years global stocks have done well or US stocks have done well, but by very thoughtfully putting a portfolio together. It's very easy to just say internationally diversify, but where and which components through what vehicles becomes very important. I have noticed last year a huge trend towards purchasing past returns of international funds, but that can be harmful again. It has to be very thoughtfully done, but clearly global diversification is very important. I personally have around 30% of my portfolio in international funds. So that's something where I'm saying what I actually believe in.
Ashish, can I squeeze that question in for you as well? Would you believe what an ideal percentage for international funds? It may not necessarily be similar answer to Kalpen or whatever. Your thoughts might be different, but just wondering if you do believe international diverse investment is important, what percentage ideally?
Yeah, I mean, I actually agree with what Kalpen said. More like 20-30% is a pretty good number to actually have. And I can actually provide a testimonial for what Kalpen mentioned, because I keep exchanging notes with him quite frequently. And in fact, a year back, he told me that, you should invest outside the country, with stuff like, say, energy stocks or metals. And DSP, of course, has some of the best products in that space, like, the World Gold Fund or the Energy Fund, etc. So he, in fact, did tell me that this is what he's thinking about and this is what should be there in people's portfolios. And everybody knows that that's what's worked out very, very well. So I think, clearly, I think Charlie Munger, actually, maybe it's attributed to him, but he said that, if you tell me where I'm going to die, I will never go there. So, that's basically, that talks about human beings' inability to predict, which is the right. There's no such thing as just-in-time investing, or there's no such thing as right place, right time. You have to be in every place all the time. I think that's the only choice.
Yeah, what a fantastic book that is, Ashish. So all I want to know is where I'm going to die. it's just quite remarkable, really. Okay, of course, Ashish, Somaya is first-hand experience of multiple Omaha meetings as well, so he brings that wisdom too. Maybe Kalpen does too, but at least I know about Ashish because we've exchanged notes on that. Okay, let me come to you, Ashish, on equity versus debt. To both our guests, I would say that I know your answers will be that both are important, and you will give me that answer, so that's the standard answer. But I would also want you to couple it up with in a period over the next 12 months. Do you think that compared to normal returns that each of the asset classes individually give, can equity give better returns than its standard returns that it does versus, or do you think debt can give better returns than the standard returns that it does?
Yeah, so I would say that I expect equity to outperform. I think you already put in all the disclaimers there on our behalf, so I'll not bore you with that. But I would still stick my neck out, and I expect equity to do better purely because of whatever I believe about the economic cycle. See, most important thing what we should keep in mind is that pre-COVID, the global economic cycle versus India's economic cycle was asynchronous. So pre-COVID, the West was booming. The world economic growth was 3.5% to 4%. US was 3.5%, and we were at 4%. So that created a situation where we had no elbow room to prime our economy. If you remember, in 2019, we had 4% GDP growth and 3.5% deficit, and we were talking about cutting the deficit, which means growth should have gone even further lower, and eventually deficit would have gone up even further. But after COVID, if you see 2021, we said deficit is going to be 7.5%. Forget sovereign downgrade. People are giving us more money, and the rupee is stable. So what has changed between 2019 and 2021? The only thing which has changed is that global economic cycles have been forced into synchronicity. And that's why the world is giving us enough elbow room to prime ourselves. So to cut a long story short, I would still weigh in favor of equity. Of course, you cannot wish away fixed income in your portfolio, but even within fixed income, given the view on the economic cycle, you see, for example, what is happening. There are alternatives to fixed income, like there is commercial real estate, there are real estate investment trusts. These are trading at great yields. So not saying you should not do fixed income, but even in fixed income, you can express yourself differently.
Thanks, Ashish. That helps. Kalpen, what about you? Equity versus debt. And I know both will be an answer, but aside of both, as I told Ashish as well, or as I compulsively told Ashish, you have to tell us what could do better.
If you force me to choose any one asset class, I would say
relatively. I'm just asking.
Yeah, that's true. So hence I would say equity, because going by past statistical track records, around 60% of times equity annually has earned better than fixed income at large. So the odds are 60-40. And the only disclaimer I'll add is, generally after a very high cycle, a very fast move upwards, there is a phase of consolidation. And I'm not trying to map it to history, but if you look at 2010 to 2013, were again periods of 3-4 years of consolidation. But this time the economic cycle, like Ashish mentioned, is extremely strong. So keeping that in mind, I would say equity should do better than fixed income.
Viewers, keep in mind, it's a wrong question to ask per se, because generally the equity returns are always higher than debt returns. But which is why I asked my guests that compared to the normal returns that debt gives versus normal returns that equity gives, do they think that equities could do better than the normal returns versus debt can do better than the normal returns? So
since you have rephrased your question again, maybe
I didn't rephrase. This is how I asked Ashish as well. But tell me.
Okay, I just felt that if your question is, will equity give more than their normal returns? Here, I would say probably not. Again, getting into the zone of astrology, which I'm not good at. But like what is normal returns? Generally, when you do data crunching from all sides, long-term returns converge closer to our average return on equities. And our average return on equity, varies from 10% to 20%. In a down cycle, we are at 10. In an up cycle, at 20. We are somewhere at 14, 15 right now. But the market knows it. You and I know it. Everyone knows it. So it is also in the price. So, a lot of good news, a lot of turning points are also captured in the price. And hence, I would say that my expectation would be, I'll be happy if I get even the regular returns of equity. I would not be expecting or be greedy that I will get more. That like Ashish started by saying that a lot of good returns, 2021 was the year for that. Maybe 22 will test all the new money which has come in, all the new investors which have come in, and will test the real patience that are we really long-term investors or are we just chasing last year returns?
Wow, interesting. Let's see. Sorry, Ashish, did you want to make a point? Did I hear you make a point?
No, I was just saying that, there is, people say that consensus is generally wrong. It's not true. It's not necessary that consensus should always be wrong. If you, not making recommendations, but if you take a recent example, ICICI Bank's performance is the best example that it's not necessary that consensus will be wrong. So, I hope that the Indian market in general does just like that bank.
Inshallah, as they say, that would be quite something really. Okay, let's move on to the next question. And Kalpen, I know you will say that forecasting is pointless, but the idea is to just try and get an more informed view than what all of us sitting on this side might have. And hence my question, between the different market capitalization segments, large cap, mid cap, small caps, which one do you think could outperform and why?
So Neeraj, my take is generally I do believe in reversion to mean, and in the long run, me and Ashish used to drive together 20 years back to work from suburbs in Borivali all the way to Bellart Pier, and he used to drive, and the idea was to keep changing lanes. This lane thoda khali hua, so let's go there, and then this lane would go ahead. So the big learning is ultimately you'll take the same 2 hours that you normally take. Trying to switch lanes has never really worked. So I feel that big swings have happened in small and mid caps, and they've run up a lot. And like I said, last year was a year of great surprise because companies improved profitability, they improved margins, their costs were lower. But as we normalize, a lot of these operating numbers could disappoint. And while we talk, also we are hearing about margin pressure. We are hearing about dominant companies saying that our margins are coming under squeeze. So on one hand, most of the good news has been priced in, and incrementally, most of the good news and most of the good companies are priced to perfection. So any small disappointment can lead to significant price fluctuations. So I would be more biased for diversified portfolios, independent of market caps, where the fund manager chooses whatever he feels is right. If there are 3 good companies, irrespective of them coming from small caps, so be it. And if there are 4 good companies coming from large caps, so be it. But these are times to be more conscious of the fact that don't polarize capital to any one idea. Be with all and continue the journey of compounding without sharp fluctuations. So diversification again in market caps rather than any single market cap.
Into crypto as well, Kalpen?
So yesterday I just for the first time met someone to say कि थोड़ा crypto क्या है सिखाओ मुझे, because there is a feeling of being left out and not being aware of what's happening. But to be honest, I still am not able to figure out what is the driver of that return. Like in equities, I can say that ROEs and multiple expansion or contraction and dividend yields, these are the broad drivers of return over a full cycle. In fixed income, your starting interest rates are your drivers of return. In crypto, I still don't know. So I'm the wrong person to really comment on this. I really have no clue. I'm a student. I've just entered junior KG, and with some more reading, maybe in the next summer discussion, I may have some answers for you.
Well, we can have an off-air conversation about this, Kalpen.
I will learn from you.
Well, no, I don't know if I can really teach it as much, but yeah, just a little bit of more reading than maybe you for a change. Otherwise, Kalpen is a vociferous reader, as I know. Ashish, what about you? Mid caps, small caps, large caps, crypto? I wanted to squeeze in international investing, but I already spoke to you guys about it. But where do you believe the larger allocation should be, according to you?
Yeah, I mean, I'm with Kalpen on this one because, best to leave it to the portfolio manager. Clearly, I said earlier also that, now we've got to be with the GDP growth and with the corporate growth. So the easy money is out of the way. And that really needs some discerning, kind of decision making and active management. So multi-cap is probably the way to go, no doubt about it. As far as crypto is concerned, again, I think we're not, not in the right place to really make too much of a commentary on it. Only thing I've learned is that, blockchain technology itself, I think that is something which one must really work hard on and invest into. Crypto as a application of that technology, I'm not sure how far it can really go. So I'm more keen to understand about the technology and figure out if there are ways to invest in the technology itself, but not so much in the current application that we are seeing.
Through the MF route, you think, Ashish, you guys will come out with some innovative things as a new house on the block? I mean, new house on the mutual fund side.
I think.
I'm just wondering.
So I would say that, first of all, I'm not very aware of how many investing opportunities per se into the technology itself are there. But I think any good, any technology company or any digital technology company, I think you should be able to express yourself through your, multi-cap funds or, whatever gives you that opportunity. I'm not a big fan of getting, into any corners or cracks or crevices of the market, like say sector, for example. Because whenever you operate in any corner, crack or crevice of the market to generate outperformance, generally the market takes it back from you. So huge outperformance usually followed by huge underperformance. So best to, even if you believe that this is a technology that you should find in your portfolio, then still it should go the multi-sector, multi-cap kind of way.
Alpen, can I just squeeze in something out of the blue before we go to the last question? And which is, you guys have come out in the past with some very innovative products as a house history. I mean, DSP BlackRock and then DSP as well. Do you get tempted? Do you get involved into conversations which might mean that Indian money gets invested in a fund which is using or investing in blockchain technology, crypto assets abroad? Because that's where it's largely prevalent, so to say.
So Neeraj, currently Indian money can get invested only under the framework of regulations that SEBI allows. So whether in India or even when we transfer money outside through fund of funds, so even those funds have to be governed by the SEBI regulations of what we are allowed to invest, right? It has to be only listed equities and listed bonds. So there are many interesting funds outside. So we are, discussing about an idea which is driven around global innovation and how technology is transforming and creating enabling value for all industries. So technology is not just software companies or tech companies, but even in healthcare there are there is robotics or gene sequencing and DNA testing and so on and so forth. So there are many applications of technology, and we are trying to curate a portfolio of 4 or 5 underlying themes and funds coming together, which we will talk more about it once we file with SEBI for an approval. Could be around a month away, and some part of it will have some of these disruptive technologies, what Ashish mentioned about companies which are involved in how blockchain can make an impact in terms of overall processes, companies where which have set up exchanges. So like I said, for crypto, understanding where are the cash flows coming from may be a challenge for us to understand, because we are very naive in that. But there are opportunities in that space where there are companies generating cash flows and which are involved. So some work we are doing on that. Maybe a month or 2 from now is when once we are better prepared, we'll be talking to you.
Very cool. Final question, and as much as I know you guys hate talking about the future, but I have to talk about that because people want to know what's happening in the next SAMVAT. So Kalpen, to you first on this one. Will the Sensex, will the Nifty be higher than where we are this SAMVAT?
Yes. Yes.
Oh, the answer is an unequivocal yes. Okay.
I thought I'll surprise you for a change.
You did. You did.
You are very, because anyways it is randomness. But my bias would be to say that things are stable, flows are stable, fundamentals are improving, valuations are expensive clearly, but they've been expensive for many years now. There is a small risk of huge disruption because of interest rate cycle reversing globally. But that apart, most of the pillars indicate a stable trend, and hence I said yes so quickly.
Okay, well, that's a smiling me taking care of the surprise that you caused. But yes, you did surprise me, so thank you for that. Ashish, what about you? What do you reckon? Significantly higher, or just about even Stevens?
So, no, I would say higher. Higher. I mean, significantly higher would be like 2021. I don't think we're going to see a repeat. So I would say higher than where we are, and that's the expectation. Okay,
gentlemen, let me throw a surprise before we wrap up. One key health tip, because I know both of you look at health as actively as wealth. One key health tip before we wrap up. Ashish, to you first.
I'm trying not to eat after 6 p.m.
Wow. Intermittent fasting and all?
Yeah, I mean, no terminology to it, just avoid eating late in the evening. That's it.
Oh, cool. Okay. Well, Ashish, then that's curtains to a pizza and a wine at Tetulia, but so be it. No problem.
Saturday afternoon, I guess then.
Okay. Kalpesh, what about you? One key health tip.
I think half an hour of yoga, half an hour of walk, these two things every day. It's simple. It's like daily SIP in health.
Oh, cool. Gentlemen, both of you, thank you so much. And to you and yours, a very happy Diwali and a prosperous New Year.
Thank you, Neeraj. And
Thank you, Neeraj. Happy Diwali.
Happy Diwali and a great New Year to all the listeners and viewers. Have a nice day.
Thank you. Lovely having you. And viewers, thanks for tuning in. To all of you as well. Tomorrow is the big day. Happy Diwali and a prosperous New Year.